there has been a lot of investors from all over the world, actually, that have been interested in knowing more about Teqnion and investing in Teqnion. But we have very little free float. There is very little stock that is trading every day, which I'm happy about, because I think it means that we have shareholders that are interested in being part of this long term, rather than speculating and trading over our reports.
Welcome to the Investors Podcast and this special interview that's only featured on our YouTube channel and not our podcast. I'm your host, Stig Brodersen, and I'm here with the CXO, Daniel from Teqnion. Daniel, thank you for making time for the viewers here and talk to us about Teqnion and what you guys are up to right now.
Thank you, Stig. Thank you for having me. So Teqnion, for everyone that hasn't read about us, is a Swedish serial acquirer. What that means is that we have this twin engine of growth. We have our own companies that are 26 and together make a revenue of 1.5 billion Swedish krona. And they grow a little bit organically. Not a lot, but GDP plus a couple of percentage units over that. And then we use the cash flow from the companies that we have in the group to acquire new, nice companies. And typically we're looking for business-to-business, industrial, physical product selling companies that hopefully is doing something unsexy but very important that they are good at, so they can have good margins. So out of the 26 companies, 23 of them are in Sweden. We have 2 in UK and 1 in Ireland. So that's basically Teqnion in a nutshell.
Wonderful. And if anyone's watching this and they're more curious about Daniel's background and a bit more about Teqnion, I know we're only going to talk about Teqnion, but some of the broader lines perhaps of Teqnion, we recorded an episode, I want to say we recorded back in April, probably launched it around Berkshire weekend. So if anyone's interested, we're going to link to that in the show notes, and you can also find it here on the channel. And you'll be in good company because it was, well, Daniel who we spoke to. And so, full disclaimer, I have very selfish reasons to invite Daniel on, not just because he's a great guy, but also because I'm a shareholder in Teqnion. So take it for what that is. If I sound too bullish, take it with a grain of salt. Daniel is also a shareholder, also works there. So I don't know. I hope we're not sitting too much in our own echo chamber talking about what a brilliant stock it is. That's very often what happens whenever you talk about the same stock, but please,
wasn't that the plan?
But that was the plan. But for the viewers out there, please know that we probably both have a bias in the positive direction here. So, Daniel, the first question here in the outline is that Teqnion recently raised 175 million Swedish kroner. And so, if someone say how much is this Swedish kroner, they're probably sitting there with a Google and they're figuring out. But like, just say roughly 1 to 10 with the USD. So, I think it's 1 to 11 now, but let's say $16 million. That's roughly what you raised. And I wanted to start this interview and talk to you about the process whenever you raise capital. Is it Teqnion approaching investors, or is it investors approaching Teqnion, or both perhaps?
Yeah, it's a little bit of both. And maybe just to add a little bit of background to that, because we received quite a lot of questions regarding why we did this. So I thought maybe I could just put a few words on that. So basically, we use all the cash flow that the companies that we own do not need to reinvest in new nice companies, as I said before. And we are at a pace where we acquire roughly 5 normal-sized companies per year. And normal size for us would mean 1 million USD in profit. And given that we have a multiple of close to 5, we don't really think in multiples, but just to make an example of it, that would be 50. We borrow half of that and we acquire 5. So that would be 250 million Swedish krona that we use for buying companies. And on an operating cash flow level, we are at a stage where we are close to being able to finance that only by ourselves. Not really, but close. But the problem, of course, is that the influx of money is not linear. I would love, to have fixed installments where every month would be the same amount, but it's not. And when we buy companies, we don't know exactly when it will happen, because it's summer holidays, it's timing issues with the entrepreneur, and it can take time because the counterparty uses a solicitor that takes time, or what have you. So you have bumpy influx and bumpy outflux of capital, which makes it a little bit of a mismatch. That's one thing. The second thing is that we want to be able to go out to entrepreneurs and feel confident in that, if there is a deal to be made, we can make that deal now. We don't want to be in a situation where we cannot keep our words, where they say, okay, let's do it. And we say, please wait until Christmas. And that's the confidence. So with that said, we felt that it would be good to have a little bit of a buffer, which theoretically, of course, means more capital and lower returns on capital. But in the real world, where we are all living and working, it's very difficult to have that kind of linear projection. So having this gives us the buffer and the speed of continuing to do what we're doing, and maybe later on accelerate that a little bit. So lately, maybe over the last 1-2 years, there has been a lot of investors, institutional money from all over the world, actually, that have been interested in knowing more about Teqnion and investing in Teqnion. But we have very little free float. There is very little stock that is trading every day, which I'm happy about, because I think it means that we have shareholders that are interested in being part of this long term, rather than just speculating and trading over our reports. But that also means that when someone is interested in buying stocks, larger chunks, those chunks are not available. So we've had an interest from institutional money that wanted to be part of Teqnion. And we thought that we could see if we can take in some money, because that would be good for the Teqnion existing shareholders, so we can grow in the pace that we want to. So during this summer, where we live in Stockholm, Sweden. Sweden have a thing where you get into July, nobody works. So it's not a good time to speak with entrepreneurs, because they are on their boats or hiking or whatever they like to do. So Johan and I thought, let's take this opportunity to speak with a select few investors that we either know or think could be really good long-term shareholders and partners for Teqnion, and see if they want to be abroad. And it was a good window of opportunity, because we didn't lose out on running operations, because everything is kind of closed anyway. So we called the ones that we believed in, and a few of them, and got very good interest. So that is how it started.
And Daniel, how did you come up with the size of 175 million? Was it like roughly, you mentioned before that you might need around 250-ish a year, so that would give you enough optionality value without penalizing you too much if you couldn't find targets, or like, how did you come up with that number?
Yeah, I mean, we at Teqnion, we're not trying to be too smart. I guess if you go to a finance professor, they would be able to calculate, what is the best optimal amount. So for us, we thought, we don't want to take in below 100, because it's still a bit of work to do this process. And if there is no interest below 100, we just, keep on doing what we're doing, and maybe we try it out another time. And we felt that we don't want to go over 200, because of course you get dilution, and also we have to be practical about, what is a realistic pace. I don't know exactly when things will happen, but if we would take in, say, 300, I know that it's not realistic that we would, shop up all that money within a time frame of 6 months, 1 year, or whatever, and that would be bad for existing shareholders. So somewhere between 100 and 200, and based on the interest that we received, we kind of landed on the round number of 175. There's not a lot of magic about it.
You in the press release that you sent out, you talked about this discount of 5.8% to the price July 18. How was the price negotiated? Do you for example say we're gonna do it with a discount for that date, or was it a different price you agreed on and then something just happened afterwards, as it always does with the stock price? Or could you talk more about that process?
Yeah, sure. We did it in a quite unconventional way. We didn't have a corporate finance firm that did it because we felt that we already had investor contacts and we want to save that cost and try it out ourselves. But we have learned that it's very difficult to sell any shares in bigger chunks without giving any kind of discount. And based on what we've heard from the corporate finance firms, that number around 6% would be industry standard for a normal company, whatever normal means. But the usual way of doing it is basically that you talk with investors and try to get them to soft commit on that they want to join at a price that is close to whatever the price is. But then at the day of transaction, let's say it's a Wednesday, during that evening is where you actually set the price depending on what the share price ends up during close of markets. But we did it a little bit differently because we thought it would be nice to know beforehand exactly how much money we would receive as a company and how much money they would be paying. So we set the price of 202 SEK per share, which was the day we started it on Tuesday. And then we said, no matter in which direction the share price goes, we keep the 202. In this case, I guess you could say that the buying shareholders were lucky because the share price went upward, so it was a good deal for them. Then, of course, in the short term, it could have been the opposite, right, where it went down to 195 or 180, but we would still have taken in at the same price. It just made the process easier to know beforehand what you're paying for. And I think intuitively, for me, when I think about that, for you, when we did this, I mean, when you go to a store and buy a thing, when you buy an iPad or you buy an Apple, you know the price of that before you go to the checkout. Whilst the normal corporate finance way of doing it is that you grab an iPad, then you go to the checkout, and whatever price comes up is what you pay, which just seems weird for us.
So please just allow me to clarify. So the way it's usually done is that you agree on a specific day, and then whatever it trades at, as say the average, whatever, and that day, that's sort of like the price you come up with, and like both parties take that risk and commit to that risk. Is that right?
Exactly. Maybe after a discount as well.
Yes.
So maybe you lock in a 6% discount.
Yes, and then you say on July 18th, it's going to be a 6% discount to whatever the median is on that day. Okay.
Yes.
So I saw, Daniel, that you mentioned on Twitter that Teqnion kept 99.7% of the capital raised, which immediately made me think, what about the 0.3%? What happened to them, and how much would a company typically keep after they issue shares?
The other 6.3% is my new Ferrari. No, just joking. So typically, because I think that we are a very rare case, if not the only case that done this lately without a corporate finance firm. So the corporate finance firm would typically take a chunk of that money. It, of course, differs a lot depending on what state the company is in. If it's a very stable big company, maybe they take a couple of percentages. If you're in a situation where you really need the money to not go into bankruptcy, it could end up that they take, up to 15%, I've seen as well. So the 0.3% that we ended up paying is basically that we had one solicitor here in Sweden that helped us out with the paperwork. They also had a solicitor in the UK that were specialized in knowing the rules and regulations in the US, where we had a couple of investors. Quite different rules over there. And then also we needed to print new shares, and that had a small cost tied to it. So that's basically the three pieces.
And this was roughly a dilution of 5-ish percent. I would imagine that it didn't change the composition of the board, otherwise you're obligated to put in the press release. But I was curious about what role the board played during this process and what their take were.
Yeah, so Johan and I proposed that we thought it would be a good idea to do this and at least try it out, because the downside would be very limited if we would not succeed. So we proposed that to the board and just before the summer, and they thought that it was a good idea to at least try it out. So during the course of this, I did a little bit of preparation work, but basically the actual work that we did was between Tuesday and Tuesday, I think. So 7 days. We worked a little bit over the weekend as well. So every day we kept the board updated on what the status was, so that they felt that they were informed. And then, of course, officially they need to sign off on the end result that we would issue, as you say, roughly 5% for 175 million Swedish. So that was the board's involvement.
So, Daniel, I'm just going back to your press release here, where it talked about Acre Capital Management being an advisor to Braddock Partners. Does that mean that Acre Capital Management doesn't invest alongside the other investors? And what does advising mean in this situation?
Yeah, I actually learned quite a lot about fund structures and markets during this process, which was very fun. But as I understand it, Acre Capital is a big fund that, let's say, roughly 15 billion USD in AUM, asset under management. And that's, of course, too big to invest in something as small as Teqnion. And they have a fund under them that is owned by Acre, which is called Braddock. And but Braddock doesn't have their own fund managers. So the Acre fund managers and analysts are the ones that are making, decisions, or officially they're making suggestions for Braddock to take. And of course, that's formally in the real world, in practice, all suggestions to Braddock would be taken. But formally, Acre has not made an investment. It's Braddock, but advised by Acre. So that's why it says like that.
So you previously said here on the show and also today that acquisitions. I'm just going a bit away here from the financing of or the stock issuance here, and talk a bit more about the financing, because you've said that it's usually like 50% free cash flow, or retained earnings, whatever you want to call it, 50% bank debt. I don't know if I'm putting you on the spot here, but could you elaborate on the terms? Like, what's the duration? Interest on the loans? Are they secured towards assets? Like, how is this financed?
Yeah. So our financing, we basically have three parts. The big part of our financing is a bank loan that we have that is used and earmarked for doing acquisitions. Then we have an RCF, a revolving credit facility that we can use for more all-purpose things, but it's much smaller. And then we have a checking credit that is obviously used for only short-term paying suppliers, etc. So the financing is something, now when we're taking in more capital, we are actually underway of negotiating with a couple of banks, and including our own house bank right now, where we hope and work to get a better term deal that suits us for the next part of the journey, so to say. So in Sweden, the normal way of doing it is that you have a term that is 3 years long, and then when you have approximately 1 year left, you just roll that into something new. And for companies that don't grow so much, you probably just roll it into something very similar. Whilst for us, we try to look a couple of years into the future so that we don't do something too small or too stupid in either direction. So that's basically how the term loans look. I don't know where we will end up exactly on the interest rates, but it's the typical rate is that we pay STIBOR 90 plus a margin, and that margin is usually is a little bit higher or lower depending on our debt level. And of course, right now, after taking in this money, we basically are debt free on a net cash basis. So I think and hope that we'll get good and better terms than what we have had previously. Of course, STIBOR is up, so interest is still higher.
Okay, so and if people are thinking, well, what's that? So it's being like that changes every day.
Yeah. So STIBOR 90. I guess theoretically it changes every day, but it's locked in 90 days periods.
Okay, so whenever you have like a say 3-year term, that's the interest for 90 days, and then it's going to be renewed on those terms for another 90 days, unless
Exactly.
And then the framework sort of like changes every 3 years or the year before.
Yeah. Okay. So we have whatever STIBOR is, which is the Stockholm Interbank blah blah something credit, where you have this official term that the banks borrow from each other. So whatever that level is, we just pay a margin above that.
Okay. Interesting. Yeah. I think in this type of interest rate environment, I think that's very interesting, because perhaps a lot of people are thinking in terms of say the mortgage and how that's financed, and it's a very different type of financing for obvious reasons. But I do think it's interesting, because in nature you're looking at this. You want to time your liabilities and your assets, as is often being said, and so you're a perpetual owner, so you want to own this quote unquote forever.
Yeah.
But at the same time, you have to figure out how do you want to finance that. You could of course finance with equity, which is forever capital, but then there's also the debt component, which has your other attributes. You can deduct some of the interest, and it's a more efficient way of, like the finance professor you related to before, I would say it's a bit more of it's more efficient because your WACC would go down, which finance professors love talking about. And I think that Buffett more than once have said that it's the stupidest thing he ever heard. But you can argue to some extent that using a moderate amount of debt is a more efficient way of running a company. So
yeah, I agree. I completely agree. I mean, I usually think in the terms of that you can only die once, and given that we want to go really, really far, it's okay if we are below the optimal level, because optimal level also entails more risk. So, I mean, we are at a situation where I would say that, on a WACC basis, we should absolutely increase our debt a lot. But that also means that we could get into in more serious troubles, which we were in 2008 and 2009. And I think that was a good and painful learning experience for the people that were here. And when it comes to, as you say, I agree with you that we would love to match our credit duration with infinity. I can't say the other word.
I don't blame you.
But of course, an eternal bond would be very, very expensive, and even 10-year bonds would be very, very expensive. So what we're doing, and that's that's normal way of doing things in Sweden. We don't like to do things just because it's normal, but in this case, going outside of this 3-year credit agreements would entail so much more cost that it's just not worth it. So we just roll that every 3 years. And we believe that as long as we become more robust, bigger, create more cash flow, we will get better rates. But of course, there is a risk because you have this mismatch that when you get into economical situation, macro, where the companies perform less well on average, maybe because interest rates are high, you kind of get hit with a double whammy on that piece, on those two parts of the income statement. So that's why we want to have a low debt level so we can weather those kind of storms. And then on the upside, I think that others that have more loans get hit harder. So it hopefully also means that there are more prospects for us at maybe a little bit lower multiples on the market for us.
Daniel, I wanted to shift gears a bit here from all the numbers, if you allow me, and I wanted to talk a bit about a question that came in from one of the members we have. We have something called the Mastermind community, I should say. So it's if you listen to the podcast, DMS's podcast, then some also opt in to become a member, and then we talk, like, you can ask questions to the host or the guests, and we talk about different stocks. And one of the stocks that we talked a lot about has been Teqnion. And so this question comes from Lance from our Mastermind community. He was curious about how the HQ is coaching your subsidiaries. Could you please elaborate on that process?
Yeah, it's one of our biggest and most important questions, and we don't have the answer. It's evolving is maybe one way of putting it. Hopefully we never get to finished material, but we are in a situation where we're trying to figure out how do we do this better than we did yesterday. We don't have a one size fits all. Some companies, if we take the scale, some companies that we're just brought into the group, where we have kept the CEO and the previous owner that have been running it for the last 20 years, 30 years or whatever, then there is very little coaching. I would say close to zero. It's just, teaching them how to do the reporting, basically, while we try to learn as much as possible about their company. We have nothing to teach them in the beginning. We just want to learn before we come with more stupid questions or stupid suggestions. Then I think the coaching becomes more intensive when we have a person that is brought from the outside, a person that has not worked in this company, not worked in that industry, and maybe most often never been a CEO, and maybe not even worked in a company size like this. In that case, it's really about telling the Teqnion story and that specific company story. Why do we do this? Why do we exist? And how is the subsidiary, such an important part for Teqnion as a whole? And I know I'm talking about very broad terms, but what is super important is basically that the person needs to feel loved. They need to feel that we support them, and they need to feel where we want to go. A lot of people think that their job is to come in and grow revenue and become bigger, and we have to tell stories and let them know that no, that is not your job. Most often it's absolutely not the job. It's about creating cash flow at low risk. And if that comes at the cost of no growth because capital can be allocated elsewhere, that is the truth. And that is, what we should focus on. And I think one thing that you and I discussed this morning, which is, I think, a very difficult balance, because every company CEO wants to do the best for their company, right? And some companies are in a situation where they have very, very high returns on capital, and I would love to send in, all the 175 million to that company, but they cannot use all of that cash. Some of the companies are in a situation where they have very low returns on capital because they are in an industry that is much more difficult. We tend to not buy those companies nowadays, but previously, many years ago, when we were poorer, we bought companies that we could afford. And if you're a CEO in one of those companies that have low returns of capital and maybe not super bright, dreamy futures, you still want to do the best for your company. You would love to reinvest the capital into your number one, number two, and number three idea. And the balance here comes from that they should absolutely think in that. How do I make this best for my company, the subsidiary? But for us, when it comes to CEO coaching, we need to understand that, company X number one idea is maybe idea number 127 for the group if you rank it by return on capital. And striking that balance so that they still feel that, they're running the company as if it's their own and that they want to do the best for it at the same time as the cash can be used in better ways somewhere else. I think that is the essence of, getting it right, which is super difficult. We are not there. We're working on it.
So the way that you're working with that is that you're having some sort of internal rate of return, hurdle rate, and you say if you cannot achieve that, which would be in cooperation with someone from Teqnion, the HQ, you would then rather send that back to the head office that would then allocate the capital?
We don't have a formal process where you would fill in an Excel sheet or so. It's about speaking with the people, and big investments have to go through the board. So I guess we kind of have that Excel sheet in the back of our minds. If it's too bad, we would hopefully say no. So those are the big decisions. But then when it comes to CEO coaching, we have 3 CEO coaches, Mona, Anna-Karin, and Håkan. They also do quite a lot of concrete stuff. It can be that they help out with recruiting key personnel because these 3 persons recruit people all the time. And of course, if you do something a lot of times, you become better. Sometimes they help out with doing sales within a very specific niche where they maybe know someone. Sometimes they help out with, especially Anna-Karin helps out with work environment because she has been doing that many times. So it really varies, but they try very hard to not help with pure operational stuff that the CEO should be doing, because we want them to feel that it's their own and not that, someone from HQ comes in and takes over their job. But when it comes to things where they explicitly ask for help or something that you have never done before or maybe do once every 10 years, sometimes some of those things, one of those 3 have done more often.
So, Daniel, you're in this wonderful position where you can acquire companies from, let's call them motivated sellers who need to sell the company for whatever reason. They don't want to anymore, divorce, death, whatever the reason might be. And we've discussed how you are this perpetual owner and you do not intend to centralize or move the company you acquire. And some of these companies are not located in metropolitan areas. They're like in rural areas. And but let's say that that you cannot retain management. Perhaps they don't want to, perhaps something sad has happened, for example, death or whatever the reason might be. How do you find the CEOs in these for these specialized companies, which might be difficult enough? Because you also mentioned last time that it was probably a good thing if you didn't even know what they were doing. Like if it's very, very niche, so very few know this, but at the same time, you also want them to move to Kiruna. And I don't want this to sound like Kiruna is a bad place, because I kind of feel like it makes it sound like, but let's say that the person doesn't want to live in Kiruna, which supposedly is very beautiful.
This is one of the most difficult tasks that we undertake, and this is also one of the biggest reasons why we feel right now that we cannot acquire much more than 5 companies per year. Because when I look at companies, I love when they have management in place, and I love when they are on the younger side, because then we get the possibility of knowing the company, and we can postpone the CEO succession for a while at least. But of course, we also buy companies where the CEO wants to shift out within 3 years or so. We always say that you have to stay with us for at least 2 years on some kind of level. We have done so many mistakes when it comes to recruiting CEOs. I mean, buying a company and spending 50 million, that's, I don't know if easy is the right word, but you can do that. But then you can also recruit a CEO and put that person there. And if it's the wrong person and we don't, act on it quick enough, then we have squandered 50 million of shareholder money. I mean, it's so easy to squander a company that is so small. So I think what we have learned is that we let it really take time. We have a case now where we hopefully, during these few days, have signed a new CEO because the seller wants to retire. And we knew that already a couple of years ago. And Mona has been working with finding a replacement for roughly 18, 19 months now. And it has been, I know how hard she's been working at it. And I know, how frustrating it has been going through so many people. And there's always something that is not right, either because they don't want to move there, or, they thought the job was something else, or, compensation level or what have you. But what we have learned is to really have that patience, because sooner or later, we hope that we can find the right person, but it really takes time. And when you're stressed and you just want to find the right person, it's so easy to believe that maybe this guy or this girl is good enough. But just to step away from that and really have that patience, I think, is one of the learnings that we've had. We've also learned that we do a lot of scouting ourselves. Sometimes we ask recruiting companies to come up with names, but we always do the later part of the process ourselves, where we speak to the people. We always have at least 2 people from Teqnion speaking with the potential CEO candidate. We do tests on personality, on logic, and we always take references ourselves. And we let these processes take time so that we have a fair chance of finding the right person. But it is super important, of course, and also so difficult, because even if that person seems smart and have done a lot of cool things, you never know how that person will fit in a different context that is usually quite different from anything else.
I just wanted to jump in here and tell you about this new valuable resource that we created for you. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. If you're not satisfied with where you're at financially, whether that be not having enough savings at the end of each month, watching your cash being eroded away by inflation, or maybe you're not sure where to get started with investing, down in the description below, we put together a free guide for you called The 4 Simple Steps to Take Control of Your Personal Finances and Life. You can get this free guide by clicking the link in the description below.
Yeah, I don't know if that answers anything, but really taking time. And yes, it is super difficult. And I think one of our most both important and most difficult tasks to do.
Yeah, I think you bring up so many good points here. And first of all, I should say that I really like the transparency that you have here, and you talk about that it's a real problem. We very often, whenever we talk about serial acquirers, you get the bold thesis, probably for good reason, that they're what we call motivated sellers, because they have to sell for whatever reason or want to sell for whatever reason.
Yeah.
But that typically comes with a headache too, and so it can be very tempting to look at the PE and be like, oh, that's 5 or whatever kind of number. We got to make 20% return here, in the assumption of everything is what tech nerds are calling, or so or accounting nerds are calling going concern. Like, you're just going to continue doing what it's doing, but the entire premise of this is that it's not going to continue. That's the entire point here. So I think it's very important to say that. And Buffett has this wonderful quote where he says that you have to buy a company that's so easy to run that even an idiot can run it, because eventually one will. And that might be true for a certain size of company where it's not just a CEO, but even for that size of company, and especially for smaller size companies that you're working with Teqnion, it's just really, really tricky not to have the right CEO. So I just really appreciate you.
I mean, ideally, we of course want to buy companies where there is already, a crown prince or crown princess in place. And of course, it's not always that easy, but it is really difficult. And I like that you bring up the point that it's easy, I think, from the outside to see, just look at the numbers, look at the income statement and say, this will just continue in whatever direction you want to point it. But every single piece that we create is, of course, made by someone, sometimes with the help of a machine. But when it comes to decision making and a very important part of the sales, it's the CEOs. And the CEOs, whether we like it or not, for our daughter companies are super important. It's difficult to put a percentage on it, but it's really, really high. And especially if it has been the entrepreneur that knows everything by heart, that knows everyone within the industry, knows all the rule of thumbs, and works super efficiently. That is difficult. And I mean, maybe even more extreme, I guess, when it comes to the music industry, if you take away Jay-Z or Beyonce and say, let's put in someone else, let's call it Jay-Z, let's call it Beyonce, but it's me instead. I mean, that's not going to generate money. And I think we're not that extreme, but it's a true challenge that we need to find someone that can fill the shoes of Jay-Z when Jay-Z leaves.
So, talking about JC, I want to talk about Johan. No, I don't know if I can make that that there, but Johan. So he's the CEO of Teqnion, and
he's the JC of Teqnion.
He's the JC, as he's also known, the CEO and JC of Teqnion. Yes. And so I saw he was doing a talk where he was talking about removing the CEO in companies if they're not good for the culture. I'm curious to hear, like, how do you measure that? Is it as simple as just looking at the financial statements and seeing profitability shrink, or is it a survey you do for employee satisfaction, all of the above? Like, how do you approach the cultural fitness for the CEO?
Yeah, it's this is also difficult. It feels like a lot of things we do are difficult, but it's fun. This is one of the interesting areas, and we've tried many different things, and we've also, some companies ask us, shouldn't we do formal surveys and such? We don't do that because our feeling is that the companies that we have are so small, so that the CEO should feel and know all the people, and also knowing in which direction the culture is going, if it's going worse or if it's going in the right direction. I think using surveys are good when companies are big, but it's also somehow that you outsource a part of the responsibility instead of being up to date and really speak with you, Stig, every day to see, are you happy? Are you smiling? I can just do the survey once every quarter, and whatever number I get right. We also try to have a very good and open relationship, and everyone, of course, at Teqnion, but the CEO coaches, it's part of their job to have very open and direct relationships with the employees at the company. So not only the CEO. And so far, it feels like it's working. So when it has happened that people are dissatisfied for some reason with the CEO, we always get the information through the back door, so to say. And that is, of course, information that we have to handle very confidentially. We can't go to the CEO and say, X and Y thinks that you're bullshit. But it raises a flag. And usually what happens is that you get maybe 20% more calls from the CEO calls or whatever number. Maybe they go to your unit a little bit more often and speak with you. So like very many things, most of the things at Teqnion, we don't really build it on formal processes or, documentations or surveys. We do it on a case by case basis on some kind of soft values. And we really feel like, some companies are so small. The smallest we have 6 employees. And that's just a normal sized family. If you're a CEO and can't feel, is the culture going the right direction or not, you're probably not fit. It's probably like home. I don't think that anyone's mom or father is sending out, quarterly surveys. Are you happy in your family? Of course, most of our companies are around 20, 30 employees, but that's still small enough that you should be able to feel it. And one thing that I want to stress is that, we have our culture at Teqnion. And when I say Teqnion in this case, I mean the 7 people that are working at the mother company. Every subsidiary has their own culture. We don't really care what that culture is, as long as it's a good culture, which means that, you have to take care of your employees. You have to have a good working environment. You have to ensure that people are happy, and we want people to work there not only for money, but also because it's more often than not fun and inspiring. But apart from those things, you as a CEO, feel free to, set your own flag on it. But of course, we like change, but we don't want it to change too quickly, because people overall don't like things to change too quickly. So when we acquire a company, of course, they already have a culture. Then we want, and if that culture is good and has been working, we are very protective of that changing too much. So that's more or less how we think about culture and how we try to figure out if things are going the right direction or not. But it's tricky, of course, because it doesn't happen overnight. Of course, there's also hard measures. When people start to have more sick leave, when people start to change jobs, those are hard facts that something maybe is not right. But those are also tracking indices, right? So when those things start to happen, maybe it's already a bit too late.
Yeah, and Daniel, could we talk a bit more about motivation? By now you might be, oh God, haven't we just talked only about motivation? But if we can include this component of financial independence, so quite a lot of the people you work with, and it could be the CEO of a subsidiary, but it doesn't necessarily have to be. For someone who is well off, how do you motivate that person to do whatever kind of job that is?
It's we don't really think about it. I don't know if that helps or not. Of course, I know how much money the sellers get because I was part of that transaction. But after that has happened, we tend to not think about it and just run the company or support them in running the companies as if nothing has happened. I think that somehow thinking too much about, having a price tag on someone's head, thinking that, this guy has 5 million USD or this guy has 10 million USD, that probably changes a little bit in the way that you would interact and try to motivate them. But I think that most people, disregarding from money, want to be part of something and they want to be good. They want to improve. And especially the people that are entrepreneurs and run companies, they want to feel that they've done something good that is better than last year. They want to feel that they have maybe become even better than a sister company, and that they are part of a group that is, in lack of better words, but a group that is winning, growing and making more profit. That is some kind of pride in it. And I also think that for the entrepreneurs especially, that have sold their companies to us, I mean, yes, they are financially independent, but they've spent so much time with the company, the brand, and the employees. And as you said, in most of our cases, it's not in Stockholm, it's in small cities that nobody outside of Sweden, maybe Denmark, can even pronounce. And it's important for them that the people that are working there are still happy, and that they feel that they can be proud of what they have left after selling the company. So it kind of solves itself. It doesn't, but part of it solves itself by that these people are self-motivated to begin with. I don't think that they know how to just step back and do nothing until, later years. But apart from that, we try to make people feel that it's fun to work here, that it's worth spending the time. And I think that, I mean, in modern society, this becomes a little bit philosophical, but in modern society in Sweden, and if you have a job like you have within the Teqnion group, I think that if you cannot be happy with that kind of salary and that amount of money, nothing is going to make you happy. Adding a zero will not make you happy. It could be something to chase, but if you're unhappy, you're going to be more same happiness, but with more money. So we focus more on the soft things that we believe that is just fundamental for human nature, that you want to be part of a group, that you want to feel that someone is catching you when things are going wrong, that you have support, that you have friends, and that you do fun things together and build something sustainable. It sounds super fluffy, but that's really how we think about things. We also know that a lot of people could maybe find a job or do something else that would make them more wealthy or earn more income. And our job is to ensure that we bridge that delta with soft values, whatever you put into that word.
Yeah, that makes a lot of sense. And whenever you look, I should probably say that the reason why I wanted to ask you this question was because Warren Buffett was asked the same question in Omaha for someone in the audience, and he said more or less the same as you. So, I mean, what can I say, Daniel? Yet another comparison between you and Mr. Warren Buffett. But I
think that, sorry, just to put a few more philosophical words about that. I mean, my view of it is that life doesn't really have a fixed purpose. You just have to find your own purpose, and winning or growing your cash flow or whatever is just fun, because I guess you have to live the 80, 90 years or whatever time you have on Earth, and doing it with friends that you think is fun, or actually that you can sustain just sometimes painful times, to do things that you feel is worth something, makes it, I mean, that's the way I think about things. And I think that deep within most people, I think it's quite similar.
Yeah, and also to one of your points before, Daniel, there's probably also a selection bias there. Like the people who have made it thus far, that's perhaps just not just how it's ingrained in them. And let's say that they're in the habit of spending less than they make, and some would say that's absolutely ridiculous, because if they ever got in that position, they would definitely spend a lot more than what they made. And you're like, yeah, but there's also a reason why they got there in the first place and you didn't, because you sort of like saw it the other way around to begin with.
Exactly. exactly. And I think that, I mean, it's a very interesting question, but it's of course broadly could be applied to everything in life. And I guess going back to JC or one of my big idols, Lionel Messi, I mean, both of those guys are financially independent and they've won most of the things that are you can win. But I mean, he still went to the US and, you know, decided that he's going to be best. He can decide to not be best and just, you know, walk around on the pitch or not play. I mean, he has enough money for generations, but he probably doesn't know how to not try to be the best.
No, that's probably true. Daniel, I wanted to talk a bit about the valuation of Teqnion, and I'm not going to ask you for like give me a stock price and then, you know, with 3 decimal points. We got to do that for after the interview, after we turn.
I can give you the decimal points, but not the numbers before that decimal point.
Right. But I'm more thinking about the approach that you want to take. So let's say that you were valuing Berkshire Hathaway, which is very often the reference point, perhaps also for quite a few other people who are tuning into this interview. They would say something like, you know, there's what's the net cash here, what's the equity portfolio, and they might have an assessment of like, is it overvalued or is it indeed what the market price is quoting them? And then they're looking at the operating earnings, perhaps they're even, or as granular, saying, okay, so Berkshire made like $10 billion last quarter, but you know, is there some seasonality there? And then they go one step further and look at the different business units, the energy, railroad, whatnot. And so this should not be about valuing Berkshire, but I was curious to hear, like, whenever we are looking across the subsidiaries that Teqnion owns, what should our technique in broad terms be to value Teqnion?
Yeah, it's tricky. I've gone back and forth on this myself, and I absolutely do not have the answer. I mean, I think it's nice to have different approaches. One approach, which is just pure pricing, not valuation, is maybe to look at companies that are similar and then on some kind of EV/EBIT or PE or whatever ratio you like to see, you know, is it higher, lower, how much? That's maybe one way. Of course, that isn't super helpful because, of course, all the serial acquirers could be undervalued or overvalued. So it wouldn't help you. And also, it's very difficult to know from the outside which are the ones you should compare to, because I know that some are closer to P8, some are closer to P100. And so, I mean, not super helpful, but one approach. Another approach is, of course, to do DCF, which is one of my previous favorite methods. The very tricky thing with Teqnion, I think, is that if I do my job right, I mean, you will not see a lot of free cash flow for the next years, because we would just use all the operative cash flow and reinvest in new companies. So the DCF becomes strange, because you would have very many years, hopefully, where you have zero free cash flow, and then you would have a free cash flow level that starts to go up, because maybe hopefully we get so much operative cash flow that we cannot acquire in that pace anymore. So you could look at companies that are much more mature, maybe Lifco, Adtech, Indutrade, etc., and see, you know, how big were they before they couldn't do that anymore, and forecast the future. The problem with a DCF, I think, with Teqnion, or a challenge at least, is one, you need to guess, you know, when operative cash flow becomes so high that we cannot redeploy it. And that's, I think, very, very difficult, because that kind of are the guy that is using up that money, wouldn't be able to tell you, not because I'm not allowed, it's just because I don't know. And the other thing is, of course, when you get to the terminal value, what makes a good serial acquirer worth maybe more or a higher multiple is that the terminal value is mostly driven by the growth rate. And if you look at companies like the ones I mentioned, Lifco, Indutrade, Adtech, but also bigger ones like Constellation Software, they've been able to have outsized growth for much longer than a normal company without acquisition. And just changing that 1% makes such a big difference. So I think a DCF is interesting, but very difficult to get right when it comes to serial acquisitions, serial acquirers that are quite young as ourselves. So one thing that I've been thinking about is, it is possible to know what all of our companies have here as returns on capital. You can see that in our accounts. And I guess after that, it would just be two pieces. By paying a multiple of book over that, you would know more or less, how much would I make if I owned those companies. And that's one piece of the puzzle, but that is going concern and also on a steady state. And then after that, I guess it's really adding a premium or a discount to whatever you think that we're going to do in the future, because that's the tricky part, right? We could squander money if we buy things too expensive and destroy them. But I think that is maybe one way that is the closest. It's also, I think, one of the ways that Berkshire have done previously, right, where they try to figure out what the book value is, and then you add a premium because it's Warren Buffett, or you put a discount if you think that it's bad. That's maybe the way I would go currently.
Talking about valuations is always tricky. First of all, you start using, or at least I find myself saying all kinds of weird expressions that few people heard about, and I mumble and I do whatever. And so I kind of feel that that's a terrible exercise. But I probably, what I would say here whenever we talk about, and we might not always explain the different, the jargon here that we're using, which is my mistake.
Sorry for that.
So I would probably say, Chris Mayer has this wonderful quote in one of his books. Chris, and I should also mention his company is also one of the largest shareholders in Teqnion, just for full disclosure, and a good friend of the podcast too. But he talks about, don't focus on what the numbers are, focus on what they mean. And I think that's very important whenever you're listening to what Daniel was saying whenever we talk about valuation, and I talked about Constellation before, and you mentioned, for example, goodwill, and there's like a difference. Like, how do you accrue your expenses? Do you acquire them and then write it off as goodwill, or does it come internally, and do you write it off in your income statement as expenses? So like there are many different ways, and pick your poison whenever it comes to accounting. But I've been asked a few times about what I think Teqnion is worth, and I would hate to come up with this, the whatever kind of number with 3 decimal points that we talked about before. So I try to avoid it, also because there's an element, like a company is not, it's not a static thing.
Well,
if the interest rate go up, the stock is not worth the same. If you ask me today, I would say something different than 2 years ago, because now the company has more assets. Now there's dilution, and so there's so many different things. So if I set a number, it's not static, and plus it wouldn't be a number; it'd be a range, if anything. But the way that I approach it is, and they say garbage in, garbage out. Take it for what it is. Like, I'm looking at the return on invested capital, and I am extrapolating that out. And then I also say, what is the expected multiple at that time? And so if you look at that return on invested capital and the multiple, you can come up with 10 different things that are wrong with both of those numbers, which is perfectly fine and is perfectly true. But it will give you a rough estimate of what you think the value is. But what you also realize is that if you say the return, if you think that Daniel can compound that with 23%, over the next 20 years and then go into a much lower growth rate, you're going to discount that back to a very different number than if you can do it for 10 years, or if you can do it like Constellation Software and do it for even longer. And so it gives you very different numbers. So it's one of those things where it is garbage in, garbage out, and it's so important how long the time period is. And it's not because Daniel is trying to hold anything back whenever he's saying, Stig is not 14.6 years, it's like 23.8 years I can count, because that's not really how it works. One great resource, I know I'm going all over the place here, but one great resource about that is Terry Smith's book. Is it called Investing for the Long Term? I don't remember Terry Smith's books. And he talks about what kind of multiple you could pay on different companies and still make a double-digit return. Because that runway is just so important. And if I can just, I think, sorry,
just spinning away together with you. I think the time frame thing is so interesting, right? Because I guess in the short term, I don't know how to be good at trading stocks, but I mean, then multiples becomes very important. If you want to keep something for maybe 6 months, 1 year, usually multiples converge, right? But if you look at the long studies, the stock prices usually correlate with the earnings per share over very long periods. And that's also why we have a slide in our reports where we have both the stock price and earnings per share on the same slide. And we hope that over time they will correlate as well. So, I mean, if the time frame for valuing a share over a shorter time frame, let's say below 5 years, I don't know how to do that. Not saying that I don't buy or sell shares within 5 years, but as you say that, Stig, if you look at Terry Smith and his favorite companies like L'Oreal, and that has been growing with the EPS with higher than market. I don't know what rate. It's lower now over such a long time. In that case, I think you could have bought L'Oreal at P 250, and this would still have beaten the market. Of course, a lot of survivorship bias, and I have no clue if we are able to beat the market. We hope we will do, but the longer time frame you have, I guess it will just be closer to the EPS growth.
Yeah.
Or decline.
Yeah, and the multiple that you're going to exit this at, I think I just wanted to say a few words to that. Chris Mayer, and I love to use his framework, and I should also plug his book, 100 Baggers. Clay has been doing a review on that book here on the channel, probably the video before, but in any case, Chris is a wonderful guy, and I think he calls it like the two engines. So like, what the earnings going to grow with, but also what multiple. And there is so if you look at a company like Teqnion, at the time recording, I would imagine that it's probably trading at 32 times earnings or something like that. And we can there's a lot of things you can peel off that whenever we talk 32 times earnings. But for obvious reasons, it makes a lot of difference if you think that Daniel and Johan and their team can compound that in like a decade or 2 decades, and can compound that 15% or 20%. Because what you also have to factor in is, if they can do that for a very long time, the multiple they can exit it at that time, and they can still show that growth, not just the track record, but also the current growth and the outlook, that would also give you a generous multiple at the end. And so, for example, something like Constellation, we just did an episode on that. I think the multiple is around 30-ish right now on the free cash flow, not attributed to shareholders, but to free cash flows. And so whenever you look at that, you would get a very different return if that was 15, depending on your time horizon. So I think that's important to look at those two things whenever you do that. And then you always have this issue where, for example, I was speaking with 2 other investors whenever we talked about Constellation. And I should also mention the stock we talked about last time was Teqnion. And so you have this issue where you're looking at a company like Constellation and you say, look how long this wonderful track record is. That should be trading at, and I'm just going to use a shortcut and say 30 times free cash flow, with all the flaws are and just using a multiple. So I'm just going to say 30 times. And you say, that's too high, because 30, and they're so big now. Like the market cap is like 42 billion USD, and so they cannot sustain that type of growth rate that they have so far. So we need they're probably going to see a multiple contraction. Someone could argue that. I happen to think that Constellation is a wonderful company, can probably do it for some time, even though not to the same extent. But anyways, if you look at something like Teqnion, you can say something like, oh my gosh, that's a small company. They can sustain that for much, much longer. But at the same time, you could also say Teqnion doesn't have the same track record, so you don't also have the same certainty. And so,
Exactly.
you can't really I would wish there was some kind of magic number where you can say this is the optimal track record compared to the outlook. There's no such thing. But I should say, and this is all my biases playing in, and Daniel is a wonderful guy, and I met Johan and he's wonderful. But all my biases, I like that Teqnion is so small, but still has a proven track record. I'm well aware that it's not as long as the one that Constellation has, but it would be very difficult for Constellation to continue to compound with a return on invested capital for let's say 20+% that they have for the next 2 decades. It would be possible for Teqnion. And please don't read this as Stig said, Teqnion will compound at 20% a year the next 2 decades. That was definitely not what I was saying.
No, and I mean, the flip side of that, I think one thing that I have learned myself, this doesn't have anything to do with Teqnion, is to get to know myself, about how long-term I am. I have 2 shares, Berkshire and Investor, that I've owned over a decade, close to 15 years now. But for the rest of the stocks, even though I've gone in with the mindset that I want to own this forever, in some cases, the forever time frame just compressed to 3 for whatever reason. Company changed, valuation changed a lot. Maybe not valuation, but price changed a lot. And I think it's important to be honest about that to oneself, because I feel it's become popular to say that I'm very, very long term, and it doesn't mean that it's a nicer thing to do. But I think it's important because, Teqnion, we have a goal that we want to double our EPS every 5 years. Hopefully we can do it a little bit quicker than that. But if for some reason serial acquirers are not popular in 5 years and the multiple goes from the 32, as you mentioned, to 16, and we double our EPS, then suddenly nothing has happened with the stock over 5 years. And 5 years is still, it's not a short period of time. It's university's 5 years. That's some time of in the grand, even in the grand scheme of one's life. 5 years is some time. So you have a lot of fluctuation risk in that. Of course, you can maybe go in the other direction as well. But when you are truly and believe that you're truly a long-term investor, as you mentioned with Terry Smith and L'Oreal, and when you get to decade plus 20 years, then the EPS engine is really what's driving the rocket, right?
Yeah. I really like that you're saying that, Daniel, and you're so honest about, are you really a long-term investor? Because whenever you say a long-term investor, what does that mean? Daniel, fantastic, and thank you again for making time here for GFP. Any concluding remarks here before we end the interview?
I think I would just continue to confuse everyone, so maybe it's best to just wrap it up.
Wonderful. If you're interested in talking more about Teqnion or Constellation Software and the other stock, go to theinvestorspodcast.com/mastermind. You can read much more about that and talk to different investors about different stocks. Wow, that was a terrible plug. I still said it. All right, guys.
Product is good. It's selling itself.
Right. But again, thank you so much, Daniel. And I think I'm just going to end it there.
We like to say, in order to finish first, you must first finish. So we're saying that we never want net debt to be too high. And in our case, we say, let's not make it go over 2.5. And as you've seen, we've been much more conservative than that. Secondly, when the stability is fine, we focus on profitability, which means that we want to ensure that all of our companies are actually creating value And that is not enough. We want them to create value, but also to capture enough of that value so that they are relevant and can reinvest money for themselves and for us to deploy to acquire new companies.